Good morning, everybody. Welcome to the Flow Show. I forgot what day it is. Wednesday, 28th, nearly the end of the month. So we've got a few of those shenanigans going on at the moment. Morning, Kay. How you doing, mate?
Good morning, Ryan. Is it Friday yet?
I hope so. Is it? You called it.
I was up for the RBNZ, and then I really had the feeling this morning when waking back up that we were Friday, but my hopes were quickly squashed.
Yeah, unfortunately, no. 3 more days left to go, and then you can have some time off, mate. Yeah. Right. Let's see what's going on in the world today. China is going to prevent fluctuations in the housing market, according to China State TV, all part of the property stuff they've got going on over there. Over in Japan, right, probably need to do a little bit of explaining to this, not much, but it covers a lot of different aspects here. So Toyota Motoring Company is recalling 280,000 US vehicles because of unexpected vehicle movement that can increase the risk of a crash. Why am I bringing this up? Well, this comes into the wages picture for the BOJ as well. There were some numbers out as well that Toyota Group's output in January fell 3.8% year on year, the first decline in over a year. That's compared to Nissan's global output rising 22% and Honda rising 20%. Now, Toyota's in a bit of a pickle at the moment to do with, let's say, they've not been very good with some of their reporting on vehicles and whatnot. So they've had some plant shutdowns going on for quite a while. Now, why is this important? It's important because in the second round of wage meetings, they did not make an offer on wages with the labour union. Now, this is just putting a bit of 2 and 2 together. Toyota is obviously one of the biggest Japanese auto firms there is. So the wage negotiations for them are going to be important. But you can understand why they may be a bit reticent in coming to a deal, or that deal may not be as big as some of the other firms. They're under the cosh at the moment. Production, as I said, is down. They're going to be facing higher costs. They're not necessarily in the same boat as some of the other automakers. So it's a special case. But the reason is if they come in with a low wage offer, the market may react to that. But I'm just trying to sort of lay some groundwork as to why something like that may happen. So if you see Toyota announcing they've only made a 3% wage increase and yen pairs take off because they construing that in BOJ terms, that may not necessarily add up in my world. So it's just looking at different parts of data to get an understanding of what may happen in another event. That's my view on it. And you got anything, any thoughts on that one, Kay?
Well, first of all, Toyota, I think last quarter or so, 2023, didn't they come up with like pretty decent revenues? But then now this is we have to know it's the biggest car maker in Japan, right? And the biggest abroad as well. They have operations nearly everywhere. Imagine that they need to operate the same thing in Europe. It may hurt them a bit. But this being said, I think the cars for the US market are slightly different than the other ones, right?
Yeah,
because different regulations and stuff in around the globe. So we shouldn't call for anything right now, but it may be that they are a bit of an outlier in those wage negotiations. They sent us also back to the 13th of March, right? So that is exactly when Rengo will come out with their estimates as well. So I think that it is 13th of March both. So that's going to be like one very important date for us to look out for those wages.
Yeah, very much so. And yeah, it is. As I say, the car recalls, it's specific, but it's just another thing that Toyota's facing at the moment. And funny enough, as we sit here talking now, Ford have announced a US recall of 63,000 vehicles, Chrysler 28,000 in one part and 338 vehicles in another part. So General Motors 56,000. So there's a big recall thing going on at the moment. But for Toyota and the wage negotiations and all things at BOJ, it's just a bit of a funky situation compared to the others. Staying on the BOJ, BOJ's Shimizu says the likelihood of inflation target achievement is still insufficient. One of the doves sounding members of the BOJ coming out there saying they're not quite there yet on the inflation front. Do you know about this guy? Is he a big dove over there, Kay?
Yeah, well, they've only got 1.5 hawk over there so, in the whole country. So it's tough to find a dove over there. Yeah, Shimizu is one of those. He's been around for a while, I think. So he's probably been educated, brainwashed. I don't know how you call it by Corona. So that's it's not a real surprise that one of those guys comes out. It's just again keeping the yen market on its toes. You had that CPI number, then the next guy comes around and he says like, hang on a minute, and we're back to exactly where we were ahead of the Japanese CPI. Exactly.
Yeah.
That was where we were, 69.70, and it is trading again 150.70. So we are just back. We see roughly with some nuances, of course, in the anti-podium market and the euro being a little bit soggy. Those crosses a bit lower, but yeah, all the rest is roughly where we actually left it a day and a half ago.
Yeah, exactly. Right, so looking at some data, start with the Aussie data. We had their new monthly CPI indicator coming out for January. It was only launched late last year. Came in, missed expectations. So came in as the same as last month, 3.4%, was expected to go up to 3.6%. So we've had a bit of a rug pull in the Antipodeans on the monetary policy front. That came next with the RBNZ leaving the rate unchanged at 5.5%. In the statement, they said the committee reached a consensus on the decision, so there were no holdouts. The OCR is to remain at restrictive level for a sustained period, and most measures of inflation expectations have declined. They said the risk to the inflation outlook have become more balanced. The economy has evolved broadly as anticipated by the committee. However, and this is probably the only hawkish tilt in there, they said headline inflation remains above the 1 to 3% target band, limiting the committee's ability to tolerate upside inflation surprises. RBNZ, or in the statement after, pretty much a repeat of all that statement, said that central banks may have to hold rates higher than markets expect. They said they did discuss a rate hike, but the strong consensus was that rates were sufficient. He said that data has given more confidence over their outlook now than in November. But overall, we knew there was a large portion of the market getting a bit hawkish. A couple of the banks predicting 2 more hikes, one last night and next one's in April and May. As per usual, those banks are waking up with egg on their face this morning. So really bit of a rug pull, as I say, for hawkish expectations, and that's been reflected in the price. Aussie dollar took a beating on its inflation numbers, and then it's also continued to go soggy with the Kiwi, and as been pointed out in our room, as we've been discussing this morning, the market writing out the potential for cuts in not just the RBNZ. It's become a brush to paint a huge swathe of other banks as well, like the RBA. So anyone who's getting hawkish over these lot, and now for seeing that all washing out. Kay, you were up for the meeting.
Yeah. well, that was the call it surprise scenario that panned out. People in the room know that I bought some downside on the Kiwi. I've let it go because and I will tell you why afterwards. But it was really a rug pull because we've been saying it. The market did go into the meeting long Kiwi, and I mean, or he didn't do a 180. He did like about a 90 degrees or so. Um, but he's not like brushing everything aside, but he for sure didn't give the market any hints that they should hike. If things go according to plan, they won't hike anymore. That's pretty much the gist of it all. So yeah, the market was long going into it, got the floor pulled out under their feet, and needed to sell what they had on, and that's exactly what we saw. I saw a bit of continuation as well on ore, and then this morning we visited now sub 61 in the Kiwi. Actually, it's funny because we keep coming back to that 60-90 figure all the time.
Yeah, another magnet.
Yeah, I mean, and as the people know in the room, I bought a put relatively cheap last night, just in case, you know, that they didn't give the market what the market was looking for, and that actually pretty much happened. So, but I'm already out of it because if you look at it from if you wouldn't know anything that happens in that happened overnight, Kiwi rates are still at 5.25%, 5.5%, right? They are not anywhere in the 3s or 4s or thereabout. They're still at 5.5. It's perhaps just people washing out their positions, and then we will maybe stabilize. I'm not excluding a move back down to 60.5, far from, but I just prefer to keep to take the beans, the dough, and sell the put out. Just take some money and decided to go because yeah, yields are not really. They came off, but they are not signaling any cuts, right? So that is something that we need to just keep our both feet on the ground for that.
Yeah,
I think
and
that
Dimitri asked a reasonable question. Given what's going on in the Swissy and your expectations for the Swissy, could Kiwi Swiss be a bit of a dip buy on this one, just to trade the Swiss size from here on out?
it's okay. I had Kiwi Swiss. I've let it go the day before yesterday because I wasn't sure about the RBNZ. And I'm also not overly sure what's going to happen with the Swiss over month end, because I mean we had 3 months in a row where Swiss franc was bought over month end, and we kind of see the same thing because, you know, a day and a half ago we were trading well above levels in euro, Swiss, Kiwi Swiss, and stuff like that, and it's coming off. So is it a buy on dip? If you're like me and in month end you trade with the clock in mind, it could be a good buy once the month is over, once we are tomorrow on the fixings. But I'm not going to give any more advice than that because I simply don't know. The only thing I did was for the end of the month I have my dollar Swiss option running. I went out of all Swiss crosses, and I'm planning to put them back on for March into the next ECB meeting. So, but that's all I'm going to say about that one. Each and every one catches the knives they want.
Yeah, I think if you're going to look at that, you need to pick your level. It may be one of these situations where, you know, this unwind of hawkishness may continue for a couple more sessions. So there may still be some further downside for Swiss pairs, Dimitri. So if you are looking to catch a knife, you know, pick your levels. I've not got an awful lot on my chart because it's not one I look at a lot. But do your charting, know where you'd like to get in, but also know where you're likely to be wrong if this move is going to continue. But it's a reasonable plan. Swiss pairs have been moving higher of late, so those pairs are looking particularly bid, and this is a counter move to that. So yeah, this could be a good one for trading one central bank between another, or one area versus another. But yeah, pick your poison, pick your levels, know where you'd like to assess your risk, assign your risk, and all that.
It's also one where you have to keep in mind that there may be speculation ahead of the SMB, but as I've been saying as well, and that's 3 weeks from now, so there's enough time, and I think the speculators will stick their teeth into it and try to sell Swiss franc into the S&P, because there's this outright chance that S&P may actually move the rates. But even that apart, it's the data in Switzerland have confirmed what Jordan was saying, that the Swiss franc was strong. But also don't forget that we've already been selling Swiss franc for 2 months, right, since the end of the year. And that Jordan also dropped that little line saying that he wouldn't like the market to undo all their good work. So also that I would already well ahead of the event caution people against getting overly excited about the weaker Swiss. It could be that we do another 1% or 1.5% in some Swiss pairs to the top side, and then Jordan comes on and says like, "Hey, hang on a little bit, that's far enough."
Yeah, and kicks everyone's asses like he's want to do now and again. Right, so let's come back to it. Riksbank's Theden says that they can cut before the ECB amid benign wage hikes, but will act independently of the ECB. I think the fact that he was talking about the ECB at all shows you how they're all chatting together. They're all talking about what they're going to be doing and may do and when they may do it. BOE's Ramsden says that he supports a more balanced outlook on the risks to inflation set out in the latest MPC forecasts. He's looking for more evidence about how entrenched this persistence will be, and therefore how long the current level of the bank rate will need to be maintained. He said that UK services inflation has been down more than expected. He did have a bit of a comment on QE or QT. He said that the monetary policy could unwind the APF, asset purchase facility, QE, fully if it judged necessary for policy reasons, and at the level of the what's called the preferred minimum range for reserves, call it the balance sheet if you like, should not affect this judgment. Our approach differs from other central banks, notably the Fed, which aims to maintain its QE portfolio at a level that will back an ample level of reserves. So this is all part of the QE QT discussion. The Fed, they're happy to wind down, but they also want to keep some of that QE, that liquidity in their reserves, keep that balance sheet there for them to use should they need to later. Whereas the Bank of England are saying that in some aspects they're happy to get rid of their balance sheet entirely, even if it goes below what they would like as a minimum reserve. Why is that important? It just means that you can tell the difference between the two central banks in terms of the QT argument. A lot of people looking at whether, if financial conditions are easing, if economies are starting to soften a bit, will central banks stop QT? Thus, that would be a bit of an easing measure, keeping that liquidity there. The BOE, pretty much in that instance, would say, no, we're going to crack on and get the balance sheet down. The reason being, it gives them the ammo to ramp it up again if they need to later on. So it's reloading the ammo chest, if you like, giving them that policy room. But the US is slightly different from that. Back to the data. We had some Eurozone confidence data out today. Italy looking a little bit soft on the business confidence, but consumer confidence ticking up there. We also had the Eurozone numbers as well, which were a little bit soggy. Headline number coming in at 95.4, which was down from the 96.1 previously, and it was expected to rise. The other metrics, services, industrials, also looking a bit softer. However, the consumer inflation expectation rose to 15.5 from 12 previously. So that is what the ECB will be most concerned about, inflation expectations rising. However, we had come off some pretty lofty levels over the last year or so. So, yeah, we've had a big steep down. So the level-wise, we're not back towards those highs, but you can see we've got a bit of a trend picking up since the latter part or the middle of last year. So there is a small rise in inflation expectations, which is what they'll keep an eye on over at the ECB. What else have we got? Some of the data from yesterday. So we had consumer confidence numbers, which for the US, they followed not too good. They followed the poor retail sales numbers. Consumer confidence falling in February. I think it's the first drop in 4 months, if I read that headline, if I recall that headline correctly. 106.7 was expected to come in largely unchanged at 114.8, but that was prior month was revised down as well. So again, reflecting what we saw from the consumer data. On the other metrics, current conditions came in down 147.2 versus 154.9 previously. I don't know why they don't have all the other bits and pieces on this calendar, but I'll read it out. Expectations also dipped 79.8 versus 81.5. 1 year inflation expectations stayed unchanged at 5.2%. So keeping the stickiness in those inflation expectations as well. That'll be for reading at the Fed. Durable goods came in softer than expected, down 6.1, were only expected to fall 4.9. So again, durable goods take out the big ticket items. You're talking things like white goods, fridges, freezers, computers, that sort of thing. So negative numbers there. That feeds into consumers as well, because if stores and firms aren't ordering those sort of goods, they're likely doing it because sales aren't living up to expectations. So we're getting a little bit of a broad picture now about the US consumer, particularly for January, and from those consumer sentiment numbers for February as well. So we need to keep an eye on the consumer just to see in case we get a little bit of a trend lower in spending. Over in the housing market, we had some house price data, S&P stuff, all tickety-boo there. Year-on-year numbers, which I mainly look at, still holding it up. A jump there, 6.1% in the 20 city. The national index came in 5.53%, up 50 pips from 5.03 year-on-year. The FHFA numbers as well, 6.6 versus 6.7 prior. So again, pretty high numbers. So there's no wobbles in the housing market that prices are telling us anyway. Fed's Bowman repeated her caution about monetary policy and also said that reducing the policy rate too soon could result in the need for future rate hikes. We also had 7-year bond sale, which Kay, you were around for that, looked by the numbers to go off pretty okay again versus the others.
Yeah, was okay. Was actually pretty okay. Yeah. No dramas there. And let me just quickly scroll back to it. Yeah, everything went really smoothly for that one. Yeah, nothing really to mention. The only thing that I would say is that it is a fact that and I've said that before, the Treasury finding their funding relatively easy this week. So market's not really stressed out about all the auctions. So but you know, it never takes that much because we don't have the schedule for next week yet, but it could take not too much more for it to go the other side. But no, for the moment, no stress there.
Yeah. And finally, the market has lined up with the Fed. Yesterday, Fed's swaps priced in only 75 basis points of cuts for 2024. Bang on the dots at last. And I still see there's potentially some risk that they start going the other way and we start underpricing the Fed. But that's markets for you, and we'll deal with that when it happens. We've already had a couple of inclinations about that. Shipping company Maersk says be prepared for the Red Sea situation to last into the second half of the year. On the shutdown front, US Senate Majority Leader Schumer said that some stop gaps will be needed to avoid a shutdown, but they had a productive and intense meeting saying we're making good progress and hope they can get this done quickly. Senate Minority Leader Jeffries says he's cautiously optimistic we can do what we need in the next few days to avoid a US government shutdown. The sources were out on OPEC saying that OPEC Plus is to consider extending the voluntary oil output cuts into Q2, and it may extend them until year end. Not such a surprise that they'll probably look to do that. Oil didn't react overly bullish on that headline. It's up, it's testing the tops of the range, which we can look at in a bit, but not going gangbusters. Kay, any other headlines you need to tell us about?
I think you covered absolutely everything that I saw overnight and more. So I think we can safely move on.
Yeah, let's move on then. Ali, you got a bit caught out in dollar yen yesterday, unfortunately. We're sorry to hear that. What's the solution? The solution.
Patience.
Yeah, there's times when the solution, there is no solution. That's just trading. The only solution I can see here is that yesterday, where were we talking about support? We were talking about support at 150. Down into maybe 149.70s. That was the area of support. That was a watch area. You put your stop just above there, just above a big figure. So perhaps, obviously hindsight's a wonderful thing, but that's why you need to know your levels. It's okay having a trade. It's okay having your risk parameters. You only wanted to risk 40 pips. That's great, but you've got to line that up with your levels as well. Where is the market likely to hold? Where can it go to? And where might it stop? Me personally, on a trade like that, I would have stuck my stop maybe around 149.90, 85, something like that, just under the big figure, in case you got such a very move. But it came down, couldn't quite get to the big figure, or it got to the big figure and then it bounced. You've got to check your charts, and even if it means you reduce your trade size to incorporate that extra 20 pips, so you're not increasing your risk percentage, you're doing the same amount just with a lower size trade. It's the same on the top. You're shorting it up here, fine, where you're wrong. If you bust through 150, 85, 88s, 90s, that's where your pain level is. So you're not going to put a stop right on that number because it could hit it, stop you out, and then you're going to find it coming all the way down. So the solution is you've got to match up with the levels, your profit and your stop targets. Right, dollar yen we've already spoken about, not doing much at all. Euro dollar seems like a lot of, I don't know if it's some further fallout from the RBNZ, just, painting some other central banks with the same brush, but this looks a bit more month-end related, Kay, I would say.
Yeah.
This dip in euro dollar.
Yeah, exactly that. And front runners getting a little bit hit left, right, and center these days. We saw it yesterday as well into the 4 p.m. and then we saw it overnight and this morning. But it has to be said that over the past two sessions, our European morning session, I've seen both cable and euro sellers a little bit, and but really, and we are talking about that very often in our chat rooms. It's a case that there's a lot more dynamic hedging going on with bonds and equity related flows. So Month-end flows are starting to get a bit, I wouldn't say random, but you can't really know when exactly they are done and when they are really going to hit the market right as the models expect. But in some currencies, the models have been right, like last month, for instance. But then in other months, and it also depends on the months. We are not end of quarter, end of year, you know. We also have to take that into account. But it's getting a little more random, those model calls, because of that. People hedging a lot more dynamic, a lot more access to electronic markets, a lot more vendors having succeeded to how should I say, get
Spread it
those
out.
asset managers on their side to do more dynamic hedging, because they showed them data that they could save some money by not waiting for the last day. So all of this is making those month ends a little bit more random in between quarter, year ends and stuff. And the other reason is very likely, yeah, just the laws of gravity, mate. We've seen Aussie and Kiwi getting smoked overnight, and the rest followed pretty much in sympathy, I'm going to say.
Yeah.
But we did see, and again, this pattern where we printed the low euro dollar this morning and in cable around 10 a.m. and we saw roughly the same thing yesterday. So I'm just telling that I don't know whether tomorrow is going to be the case again, but we did see a bit of a revival once we got the 10 a.m. fixings out of the way in London.
Yeah.
That's about what I can say about it, mate. It is, and for the rest, we are still in those proxy ranges, right?
Yeah.
If you look at the cable, you look at the euro dollar, you look even at the dollar yen. We printed 150.80 again. It's capped there again. So coming back to what Ali just said, you're back long at 77. Isn't that a bit of FOMO, Ali? Because I know it can go wherever, but we've seen that top around 150.80 already a couple of times. Perhaps, I don't know. It's and again, we are not here to tell the people what to do, but we've seen this 150.80, 85 hold a couple of times. I would have said, like, well, if it has to break, perhaps wait for the break to happen. And about your euro sterling, well, it seems like we are pegged around 85.5. I don't know what to say about the euro sterling, really. I'm staying out
Yeah.
of that right now. Perhaps March can tell us a bit more, but around here we're just ping pong in the middle of the range.
Yeah, it's a bit hard, Ali, because I don't know what charts you've got. If you're using our chat room, we can see your chart, see what your thinking is. So I don't know why you're picking your levels that you are. I can only give an opinion based on what I see on the charts. 85.50. It's a bit of an old level, bit of a pivot level. So it's in the middle. It's in the middle of what's been going on of late. Euro dollar, you're trying to short at 18. You're shorting it, in my mind, 18 pips off of support, 20 pips off of support. This is historical support of late. So, it's hard for me. I can only judge what you're doing in my eyes if you get my understanding. So would I be shorting euro dollar 18 pips off what could be decent support? Probably not. Absolutely not, I would say. But if you've got a level there, fine. You know where you're wrong. You've got sensible risk parameters, stop levels. The same with dollar yen. For me, looking at your trades, I don't know if Kay's right. You're maybe just trying to catch a move. If it happens, like dollar yen breaking up through 80s, it might do. But it feels like you're just trying to maybe chase a trade. Tell me if I'm wrong. Happy to take those comments back if that's the case. But yeah, sometimes you don't. I know you're an active trader, but sometimes you've just got to let things do their thing. and don't go chasing a trade too much. You know, let the trades come to you. No, pick your levels. Say, I'm going to trade there. I'm going to trade there. And if you're doing that because that's where your levels are, then all the power to you, Ali, and good luck, my friend. I hope you smack it right up. Right, what else should you have a quick look at? Obviously, I'm keeping a good eye on the S&P. Let me have a quick look at oil, and then I'll hand it over to the K-Man. So this is what I was looking at yesterday, and I put this in our chat room. The possibilities, I put these two in. The possibilities after we broke this level 50-80, we'll either ping pong between here before making a decision, or we might break touch down here, then ping pong back up there. So at the moment, it's looking like A is what's happening. You know, give or take a couple of ticks. The 50-80 is holding now as resistance, and now we're getting a downside test close to the 50-40 area. This is what I mean by level development. We didn't know what was going to happen all the way through here until now, and you let the price develop and show you what it wants to do. So at the moment, it's looking a bit more bearish. It's giving the top, it's going to cement this top a little bit more because we're not getting back above here. So anytime we do, we're probably going to find sellers into these levels up here. So for now, shorts are getting a bit of evidence that they can take on the market. They couldn't take on the market a lot of these times. They could have taken on the market here where we had this dip, then we moved back up, held the prior high, then you get another move down. Similar situation here. We're hitting our head. We're not going higher anymore. Can we break through the levels? So your deciding level is still 50-50, 50-40. Break that, we're probably heading down to 5K not too long after. Still in the middle here, we need to know what happens at the highs. If we hold a high a third time, so we've had this one, secondary high. If we get a move up towards here and it holds, then again, shorts will have a bit more evidence to say, let's give it a go up here, because they know if they're above 51, 10, 11, that's where they're wrong. It can be a nice tight trade for those wanting to try and pick a top. But if it ticks above that high, then this move is looking like it's going to continue. So several possibilities, but you don't need to guess where the highs are going to be. You don't need to guess the top. You can wait for it to happen and let the chart tell you where it's going to be. Right, oil, quick butchers at that. I know Mark in our chat room, big oil trader, he's all over this. Let's look at the US stuff. Everyone's seeing the same picture. The 79, 80 level is where we're finding a roof, and we're not getting through that. Can we move all the way back down again? Yeah, we can. It is looking a little bit bid at the moment, though. We're getting just slightly higher lows and just slightly higher highs. Only a couple of cents here or there, but it might be significant in the terms of price action. But it is pretty much going sideways. So if we're going below, if we're going down, need to get back below 75, 80s, 75, 76s, or we need to break 79s. If we do break 79s, can we get as high as 80s, or are we just going to have another little high and then come back down again? The fundamentals, again, they don't suggest that we should be going anywhere. We've still got Middle East risk, we've still got demand risk. So two sides of the coin for this one, which way it goes. Any big game-changing news is probably going to be the driver for this. As you can see, those OPEC Plus headlines not doing an awful lot in this one. Kate, I'm going to bat it over to you, mate.
Yeah, just a couple of things to show today. Why not do the majors? So first of all, euro dollar. I know a few guys in here or girls are, of course, everybody's watching. Look where we stopped. As I was saying, if you look at the short-term moves, the real short-term moves, today we had the print not too far from the hourlies. Look, we did like right on the hour. We printed very close to the bottom on the euro, and there is, I must say, a bit of support. So if we are still trading those ranges, which we have been for a while. We should see support around 107.90 figure in the euro dollar. Month-end flows, and again, we have to take them with a pinch of salt these days. Would suggest that that we could see this for the end of the month, but again, very, very cautious on all those calls. Anyway, a bit of support here, and for as long as that holds, we are in this range here. Okay, so we have had the European data today. We've had those. Is that second reading, I think, yeah, for the GDP, or third, or what? X reading for the fourth quarter GDP in the States. Don't think that that is going to be a big mover, but we never know. Tomorrow's PCE will be a bigger one. So until then, I'd say for as long as it doesn't break, respect those levels, right? Cable, bit similar, although. I had first support here around 126.40, 126.35, and that broke through. But when did that happen? Again, right into the 10 a.m. Into the 10 a.m. this morning. And I do think that there's a bit of month-end from European money managers also involved in those things. We did hold the 50% of the move higher, so that's encouraging for those who like to catch a knife. And then we will see now what the rest of the day brings. If it moves back through 126.65.70, there's a fair chance we are going to visit again 127. But we have seen all these attempts. We had this little one here. But we have seen all these attempts at 127 fail for now, so keep it into account. It's going to be a bit of a zone here. If ever it would break, then the next one will be around here, where the top end of the triangle lies. I still think that there's not too much in the data. There's not too much in the where is it? In the interest rate differentials either that warrant a big drop in the cable, but let's see how it develops. Actually, if you look at all those the yield differentials, they are just telling us that we are still in broad ranges, really, right? What else? There's an interesting one, yeah, for after the Aussie CPI and the RBNZ. This one is interesting, okay? We can add a bit of a line here because I know people are watching that one as well. But we saw the break of this trend line earlier in the month. And what happened over the RBNZ and the combination, yeah, especially the RBNZ, we went to really test this broken trend line here, okay? And we tagged it again and we turned back lower. I think that could be significant enough because, after all, as I said, RBNZ is not cutting rates, where the Australian weighted CPI came in lower than expected. It's not in their target zone yet, but it's coming down. Okay, we know that the RBA was also pretty reluctant on starting to lower interest rates early. But if CPI comes off, they may be tempted, and there is a little over 1% differential in favor of the New Zealand dollar still in the between Aussie and the Kiwi, and that may have been it for this rally. So if ever we would come and retest this, pay attention to what's happening around here, because it's also a prior low, trying to overshoot a little bit to go and retest 107 didn't happen, and then we came down. So this is an interesting one to watch for me. And then just to have a look at what's happening in Swiss franc, and again, you know, a bit like the dollar Swiss, this has been a decent channel. We just tagged it and we kept up there. So Respect it, okay? Just above 95.5 on the Euro Swiss for those who are watching Swiss. I think there may be some again, as we have seen past few months. If we see Swiss buying, you can come back to those 94, 50, 60 levels and then start a march again and pick the other side. On the dollar Swiss, we have seen the same. That is something I think which is in the possibilities, okay? Dollar Swiss did exactly the same. We went to test that zone. I've been warning people about that middle of February. So watch out for this level. This could be important enough. And we are shying away as well, all right? We are looking at if the dollar finds offers, we are looking perhaps at a move closer back to anywhere in the mid 87s, mid 87s around there. Or if there is a big Swiss franc to buy, just below 87 here, that would be, in my view at least, pretty much an ideal level to unhedge my hedges against my option, and then looking for the speculation into the S&P into March. And that's about it for now. Right now, I'm just looking if there's any other comments. Okay, now back over to you, Ryan.
Yeah, thanks, mate. Yeah, thanks, Ellie. Just answering what I was saying about your trading. You want to answer the question. You're a trend trader. You try to pick a position with speculators. Without the trend, you cannot trade, and you try and tack big stops when momentum develops. Yes, I am wrong many times. That's what you got to fix, Ellie. Being wrong many times. It's not easy. We all know that. But let's look at your stop thing. You know, you're trying to catch a trade that may happen. Okay, so it's a bit of a hope trade. I'm going to put it bluntly. You know, if you're long dollar yen, now you didn't say where you're long, I don't think.
Yeah, it's 77.
It's 77. Yeah, so you're long,
right on the resistance.
8 pips, 6 pips off the high. Okay, off a solid resistance area. So you're this is a hope trade. I'm not going to paint it any other way. Okay, yes, you're going with this trend and you want it to break. Okay, but why are you risking your money 8 pips off a definitive high? If you want to, and let's make it clear, you're attacking nothing unless you're keeping secrets from us and you're trading millions and millions and millions, hundreds of millions in FX a day. You're attacking nothing, my friend. You have not the power nor the pockets to take on anyone's stops. So if you want to bust stops, if you want to trade momentum, if you want to take advantage of a potential stop break, then look at a different strategy. You know the way I do it. I use buy stops, so I can position for a break, for a stop run above the high, and I'm not risking anything guessing, trying to catch it. I don't need to catch those 6, 7 pips where I can catch it above and then it moves on. You know, my S&P is the perfect example. I didn't have to buy anything below 4,800 in S&P. I stuck my stops above, my buy stop above. If it broke, fine, then I'm in a trade and I'll see what it does. But if it doesn't break, I'm risking nothing because I haven't got a trade on. So you can't attack anything. Okay, so think about what strategies you can do to limit those I lose many times. If you try this if you tried it here, 4 times, forget that one, 4 times. You might have tried to go long up here.
You're not showing your screen.
Oh, I'm not showing my bloody screen. Bloody hell. There we go. So if you tried several times to buy it up here, hoping for a stop break, you've lost 4 times on that trade. Okay. Now, the one you win, you've got to make back all those losses. Okay. So you've got to get a super duper break trade. Now, what happens if it breaks up here and slams into the big figure at 151 and there's loads of resistance there, and then it tops out at 151 and comes all the way back down again? You've not made back all your money over here. So think about what strategies you can use that lowers your risk but accomplishes what you want to do, which is to grab a break up here. as I say, I use buy stops or sell stops depending on which way it's going, because then if it doesn't get through, I don't lose anything. If it does get through, I still might lose because it might tick up through my buy stop and then reverse. Well, that shit happens, but I'm only going to have a tight stop just back under. I don't need to have 30, 40, 50 pip stop on that sort of trade. 10, 15, 20 pip stops. If it doesn't stay above my break point and comes back down, boom, I'm out. So yeah, just think about your strategies, Ali. That's the best way to look at it. Turn those ones you lose into break evens or into more winners. But we don't do hope here. Hope isn't a strategy. Okay, mate? Right, on that note, we should call it a day. Have a spiffing rest of your day, folks. Trade safely, and we will catch up with you again tomorrow. And thank you very much, Kay, as usual.
Cheers, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.